We are in Chapter 6 in our Charter Secretary Corporate Financial Management, Capital Investment Appraisal. Last day we discussed the Npv, Payback, Discounted Payback, Accounting Rate of Return. Today we'll discuss Internal Rate of Return IRR. After completing today's discuss, we'll understand IRR, advantage and disadvantage of IRR, implication of tax and inflation, and we will calculate IRR. So we know internal rate of return. The internal rate of return, present value cash inflow with the present value of cash outflow of an investment, we can calculate it, is the capital budgeting estimation, the profitability of potential investment, and the internal rate of return is discount rate that makes the net present value at the cash flow from the particular project equal to 0. That means 0 point, which point would be the 0, that is the IRR, internal rate of return. So IRR stands for internal rate of return, and we know it, and it is the rate of return for which the net present value of an investment becomes 0. So if our required rate of return is less than expected IRR or calculated IRR, then that project we should accept. So there we can calculate in different way. There are different types of formula also. So what would be the decision? A project should only be accepted if the IRR is not less than the target internal rate of return. When comparing two or more mutually exclusive projects, the project having higher value of IRR should be accepted. So it is the calculation and is the decision rules is that. So we can calculate this way. It's a series of cash flow, and from that we will minus initial investment, and that result would be 0. That point is the internal rate of return. So here accept the project if the IRR, if it is greater than the required return. Is some advantages. Advantages means there are a lot of advantages of this formula, of this investment technique. NPV method is considered the time value of money, we know, and consider the cash flow over the entire life of the project. All cash flow here consider that, do not consider payback period, etc. So it satisfied the useful terms rate of return of capital, and unlike the NPV method, the calculation of the cost of capital knows that precondition. It is a no rate. We have to find out the rate. It is comparable with the firms or companies maximizing the owner's welfare, but it has some limitation. It is very much complex and involve completed computation problem, and it is not give the unique answer, and it's multiplied. That means it's not easy to calculate. So we can say that if you look this graphical item, so where the IRR is, look here in left side net present value line, and below side discount rate. So where the 0 point is, it is the IRR. That means within this point our total cash inflow and total cash outflow would be 0, and that rate, for example here 40%. So if our required rate of return is 30% and IRR makes the 40%, so this project we should accept. But if here 40% but our expected rate of return is 50%, then we will not take the project. So here is basically said that this is the discount rate that equal the sum of the present value of all cash inflow to the sum of the present value of all cash outflow. The discount rate that set at present value equal to 0. We see present value of cash inflow and present value of cash outflow is then when cash flow are discounted, the rate of return through the rate of return, and this way we can calculate the IRR. IRR, these are the fundamental rules. Cash flow divided by 1 plus R R means discount rate, I means time, period of time, minus initial investment. So there are few examples. If we go for investment analysis, we have to calculate few technique. We need some assumption or technique. So here investment analysis, firstly we it's have the cost, the benefit. This cost with investment amount, investment cost, and benefit means it can be cash basis, accounting basis also. Accounting where we are calculating accounting rate of return or average rate of return this way. And but basically fundamental things is that we use this technique payback, so it's give us the time. So here we have to take that means payback period, accept, that means we when money comes, that means if we calculate 2 or 3 or 4 or 5 project, so which project give us the money more quickly, and that type of discount payback here calculating the that means we are using all cash flow and net present value, profitability index, average accounting return. Is not using the cash flow, this is using the profit only. So look here is a simple one IRR, calculation of IRR, and with the sensitivity, that means evaluation criteria of a strategic investment project. We can calculate this way: replacement project and replacement project for cost reduction, expansion, new product or market development, mandatory project, etc. as that. And here the project are, some are mutually exclusive, some are complementary project, some are independent. So here when we calculate the NPV, this is the fundamental rule, basic, and sometimes we are calculating profitability index, benefit cost ratio, desirability factor, etc. So PI, that means profitability index, we can calculate present value of cash inflow divided by cash flow or present value of outflow. And sometimes IRR technique we are using, and that today's our chapter is that. So IRR is the discount rate that makes the present value of project estimated cash inflow equal to the present value of project estimated cash outflow. So IRR is the discount rate that makes the some relation. What is the relation? The relation is that it should be PV inflow equal to PV outflow. So IRR is also the discount rate for the which the NPV of the project is equal to 0. So IRR equal to, sometimes we can calculate a lower rate when we take two rates, that lower rate plus lower rate NPV divided by lower rate NPV minus higher rate NPV multiplied by difference of the both rate. For example, if we take 10% or 15% and both the difference is here 5%. So how to find the standard? That means here is the calculation. Also net profitability index we can calculate this way. So project cash flow, we know that the type of how can calculate the project cash flow. So because we are working with the project or determining the profit, that means which project would be the viable for the profit, that means which project we will take. So here beginning from the sales price of the unit, and this last one is cash flow after tax. So based on that, that treatment of working capital also we have completed that chapter. So here we have to remember decision are based on the cash flow, not accounting income when we take the cash flow, and sunk cost should not be included in the analysis. Cash flow are based on the opportunity cost. The timing of the cash flow is important. Cash flow are utilized for the after tax basis. So this is the calculation of equity cash flow. Do you know the equity cash flow? The equity cash flow, this means we calculating the equity. So sometimes NPV, modified IRR, modified NPV, etc. We see here a machine can reduce the annual cost 40,000. The cost of the machine is 2,23,000 and the useful life is 15 years with zero residual value. Compute the internal rate of return if the acceptable investment cost of capital is 16%. So it is the easy, that means only one cash, on the annual cash 15 years, same amount every 15 years, but not the difference. So if we go for that answer, like very easy, look here, internal rate of return, how calculated it? You did it even in your different stage, you did it in your BBA, MBA and another professional degree. So here calculating IRR, net annual cash inflow divided by investment required. So here we get where we'll see that figure is that, so 2,23,000 divided by 40, we get 5.575. So if we go present value table, where this figure is, then time we will be able to find it under the 16%. So internal rate of return therefore will be 16%. So there is one kind of formula. A supplier is analyzing the purchase of manufacturing equipment that will cost 20,000. The annual cash inflow for the next 3 years. First year 10,000, second year 9,000. Determine the internal rate of return using interpolation. So it is another formula. Which of cost of capital is 12%? Should the machine be purchased or not? Go for stage by stage how this will calculate. So stage 1 or step 1, first we have to take the average inflow. So what would be the average inflow? Here average inflow, that means 3 years. Also you can take sometimes we are taking the just assumption, for example 10% taking and another taking 20%. One would be the result would be positive, another would be the negative. So based on positive negative NPV, then we can calculate the actual IRR. So but real formula is that we have to go for a stage by stage. Number 1, first we have to calculate the average the cash flow. So here average cash flow is 8,500. 3 years cash flow divided by 3. So divided the inflow, the assumption, the annuity is first. From that we have to take the annuity. So investment 20,000, 8,500 divided, that we will get 2.353. So if we go in 3 year, this falls into 13 to 14%. If we go for annuity sheet, then we will get this 2.353 in the 3 years. It falls within 13 and 14. So how we will calculate the IRR? Try to first approximately to discount back the inflow, because the inflow are biased towards the earlier. We will use the higher rate. Here higher rate is 14%. So taking the 14%, 3 years cash flow is here 3 years, and 14% PB factor. So year 1 at the rate of 14%, 0.877, and second is 0.767, third year 0.675. So present value will get cash flow 10,000. If we multiply 0.877, then we will get 8770 present value. So 3 years calculating the present value. If we add, we have receive here present value is, it is not the net present value, is the present value is 20. That means here 79 taka is positive NPV, because our investment is 20,000. So since the NPV is slightly over 20,000, we need to try to higher rate, because we have to find out and minus NPV. For getting the accurate IRR, we two NP net present value we can calculate. One result would be positive, one would be negative, and between that we will get the IRR. So here, though here positive, so now if we make is higher rate, that means previously it was 14, then we can make it 15. So within 14 and 15 we will get the IRR. So here at the rate of 15%, PV factor 870 for the year first year, second year 756, third year 0.658. So if we multiply with the cash flow with the PV factor at the rate of 15%, then we will get in the first year 8,700. This way, after calculating 3 years, we'll add 3 years, then we'll get 19,781. So it is the less than the 20,000. So if we calculate here NPV, that is the minus, but here is positive. But here we can calculate this way also. Because of NPV is now below 20,000, we now the IRR between 14 and 15% will interpolate. For example, here 14% PV factor is present value is 20 and 15% here minus 19. If we minus the cost, then we will get at the rate of 14% PV factory, that means net present value is 79. So here it is the formula. If we calculate here, it is the below, that means less rate. That means we are taking here two rate. One is 14%, another is 15%. So lower rate, this means lower rate 14%. That means which NPV is positive plus positive NPV divided by difference of both present value here multiplied by higher rate minus lower rate. So we'll get this 14.265. This is the IRR. So if we see that, because as per the question, the cost of capital was 12%, but our IRR, as we calculated here, IRR 14%. So it is the more than 12%. So your decision would be yes, the machine may be purchased because IRR is 14.27%, which is more than cost of capital 12%. So here, this is the formula that we just applied here. IRR. This so we can calculate here. L, that is lower rate of interest. H meet higher rate of interest. That means what we take here. So here H higher rate of interest, NL NPV of lower. This so we can calculate. So this is the way we can calculate IRR. So NPV versus IRR, what is the difference between that? So NPV tells us the absolute increase in shareholder wealth as a result of accepting the project at the current cost of capital. The IRR simply tells us how far the cost of capital could increase before the project would not be what accepting. It would be project should be accepted if their IRR greater than the cost of capital. So it is the basic fundamental rules for accepting IRR. If their IRR greater than the cost of capital, known cost of capital, then we will take the project. Implication of taxation of inflation, we know. So we have to adjust with the tax or inflation. The income tax usually has a significant effect on the cash flow, we know, and we have to consider it capital budgeting decision. So an investment that took as well as we calculated previously weighted average cost of capital. So we know that all capitals, they have the cost. For example, equity capital, debt capital, bond capital, and preference capital. So debt or bond capital also, the rate we adjust with the tax rate because that expense the city allowed for tax purpose or as an expense, they consider as an expense. So that's why tax adjustment is required. So an investment that took desirable without considering income tax may become unacceptable after considering the income tax. Before explaining the impact of the income tax on capital budgeting using the net present value, we need to understand three concepts. One is after-tax benefit, after-tax cost, and depreciation tax sheet. After-tax benefit of cash flow. So what is that? So it is easy and you know it. After-tax benefit of cash inflow can calculate this way. 1 minus tax rate multiplied by taxable cash received. So this one, the taxable revenue of cash flow when reduced by the income tax are known after-tax benefit or after-tax cash inflow. And when income tax is considered the capital budgeting decision, after-tax cash inflow is used. And we can make an example, the tax cash inflow in cash generated company for this operation after tax benefit or after tax cash inflow can be easily computed in this formula, and generally accepted. That means we know this formula is very well. We all know it. After tax cost. So here is taxable cash received, and here is tax deductible cash received. 1 minus tax rate multiplied by tax deductible cash received. So the tax deductible cash received, taxable income, help save income tax. For example, if we issue or take loan from the bank, from the interest or bond interest, it is the deductible cash expense. Here tax saving, because that expense tax authority allowed as an expense, so that's why it is the deductible cash expense. Another, depreciation tax shield. So depreciation is the non-cash tax deductible expense that save income tax by reducing taxable income, because our depreciation is we are charging in profit and loss account as an expense, and a specific rate our tax authorities allowed as per the 3rd schedule of income tax ordinance. Their rate is prescribed there. The amount of tax that is saved by the depreciation is known the depreciation tax sheet. So the formula is that depreciation tax rate equal to tax rate multiplied by depreciation deduction. So these were 3 things here. Also, there are 2 methods of use: discontinuing cash flow for inflation. One is nominal method, one is real method. So once we will take a math, then it will be clear. Come here, look here. Capital budgeting, NPV with inflation. If we are a company manufacturing silicon board that use the preparing a small, medium and large size electronic circuit, the company is considering to reduce its cost by automating some of its manufacturing tasks. This automation required the installation of a new equipment. The relevant information of net present value analysis are given below. That means cost of equipment is 72,000. Expected annual cost saving to be provided new equipment, that is 40,000. Cash saving. Useful life of the equipment is 6 years. Salvage value at the end of 6 years it's 0. That means salvage value nil. Cost of capital 23.20%. and expected inflation rate of cash flow associated with the new equipment 10%. So what would be the net present value of new equipment if the inflation is considered? If we consider the inflation and the inflation do not consider the inflation, what would be the NPV of the equipment? So if we go for the calculation, here is calculation. So computation of NPV, if inflation is not considered, when we will not consider the inflation, what would be the NPV? So this is the problem we are giving in the nominal discount rate. This rate is nominal discount rate, 23.2%. In order to compute NPV without considering inflation, the first step is to compute the real discount rate. So it is the nominal discount rate, is the real discount rate we have to calculate it. It is the computation we can calculate this way. This is the formula. So real discount rate, how we will get from the nominal discount rate. Nominal discount rate minus inflation rate, that means nominal and inflation rate both are given in the question, divided by 1 plus inflation rate. So then if we calculate this one, then we will get the real discount rate. So what is this? Nominal discount rate 23.2 minus 10% is inflation rate, divided by 1 plus 10% inflation rate, then we will get 12%. So a nominal discount rate where 23.2% is real discount rate is 12% as per the formula, established formula. So look here, annual cash saving, that means in this case from year to 6 year, every year 30,000 cash saving is here. So from year 1 to 6. So here we have given, we calculate the real discount rate from the nominal discount rate. So real discount rate is 12%. So this 12% PV factor, if we see the present value annuity, then in the year 6, it's come 4.311. So from this 4.311, if we multiply 40,000, then we will get annual cost saving, a total present value of cash inflow 1,64,440, and initial investment is 72,000. So net present value is 92,440. So it is the not considering the inflation. Now if inflation is considered, what would be the result? Look here, which is very interesting. Sometimes is both the same. So look here, annual cost saving year 1 to 6, amount 40,000. So price index number. So price index number is, look here, so 1 plus inflation rate. So 1 plus inflation rate is 10% as given in the question. So 1 plus inflation rate 10% is come 1.1 in the year 1. In the year 2, 1.1 and again impose 10%. It's come 1.21. And from 1.2, if we multiply 110%, then we will get 1.331. And the year 4, if we 1.331, if we that is 10% also add, then we will get 1.464. This way, in the year 6, we will get 1.772. It is the price index number. So within this figure, in the year 1, this 40,000 is really price adjustment cash flow is 44,000. And the year 6, 40,000 is the price adjustment cash flow would be 70,880. And now we are using this one. This is the nominal discount rate. So nominal discount rate is 3.2%. So first year is the 3.2% PV factor is 0.812. So price adjusted cash flow, if we multiply by the PV factor of 23.2 first year 0.812, then we will get 35,728. So this, so in the year 6 we will get 20,272. And if we add all and also minus that, will deduct the initial investment 72,000, then net present value comes 92,477. Look here, interestingly, both present value is the same. Look here 440, but 470, just a few difference in the fraction. So what would be your answer? That means the net present value computation with the without inflation would be the same. It is the fundamental thing. The difference here, difference is 37. It is just for our that means for rounding up problem. So calculation of that, the positive net present value indicate that the project is acceptable. The new equipment should therefore be purchased to automated some manufacturing process. So it is that we have calculated here nominal discount through the first time we take the not considering the inflation, and second time we're considering the inflation rate. So but here we have seen here the same result. So here is the some relation, that means if NPV less than 0, IRR less than cost of capital budgeting decision, we should reject it, because so we know the positive NPV we can take it, and when required rate of return is less than the IRR, then we'll take that project, etc. The math here is calculation NPV and IRR. Do it universal, and also NPV IRR. Another math. Another one is NPV after tax cash flow in the net present value analysis. So here calculating present value of tax saving tax shield, here calculated. And this one also, here is a math. This one times this math is your exam January 17, just modified something. So within this math you will be able to understand, that means payback period, discounted payback period, net present value, profitability index, and internal rate of return within the same figure. You are the company secretary of one company. Your company is going to take a project. Right now in year 0 your company will spend 1,50,000. Then the 5 year the following cash flow may generate. 5 technique of capital budgeting is within 1 month. 5 years cash inflow is here. Look here, year 1, 2, 3, 4, 5, and this is the PV factor is given here. PV factor 10%, 15%, 20%, all 5 years here, where cost of capital is 10%. Payback. So first we will take the payback period. So we know the payback, that means in the year 0 is investing 1,50,000. First year cash flow is 70,000. So remaining is 80,000. So also we need 80,000 for payback. And that's year 2, second year, 60,000 is cash inflow and required 20,000. In the year 3, their cash flow is 30,000, but we require 20,000, so 10,000 is more than required. So what would be the payback period? Here it is, we can say that 2 year is the base year and plus 2. That means, so here the formula is that how we can calculate is negative balance. That means negative balance is here 20,000 in the year 2 divided by cash flow from the break-even year. So break-even year cash flow is here. So when it is the final year, the break-even year, so derivative 20 divided by 30 equal to 0.66. So here we can add his 2 year plus 0.66. So answer is 2.66 year is payback period, discounted payback period. Same way, but we have to discount it. How we will get the discount rate? So as per the question, they said cost of capital is 10%. So if we take the 10% discount rate, this 10% discount, this figure, for example, it is the discounted cash flow, and it is the cash flow. So in the year 0, investing 1,50,000. In the year 1, 70,000 is getting from the cash flow, but its discounted cash flow would be this one. How this come here? So it's come this way. Look here, 70,000 and PV factor 10% is 0.9091. So if we multiply this, then we will get 63,637. Same way in the year 5, 10,000 means 6,209. So if we go here, this one, look here, 6,209. So this is the discounted cash flow. Now we have to running total with this discounted cash flow because we are calculating discounted payback. So here it is the minus figure in the year 0. We invested 1,50,000. In the first year, this cash flow of discounted cash flow come 63,637. So if we adjust with this one, we also require 86,000 payback. In the year 2, if we add this one, then we also require 36,000. In the year 3, if we adjust with the discounted cash flow 22,000, then also we require 14,000. In the year 4, we also require 580 only. So we can say that our discounted payback period would be 4 plus, because 4 is the figure, and here in the year 5 it is the more than 580 because here 6,209 cash flow, discounted cash flow, so positive 5,629. So our answer would be 4.9093. How we calculate it? Here this 580 divided by 6209 cash flow of that next year, that is equivalent year, then we'll get here 0.093. So if we add with the 4, then we'll get 4.093 years is the discounted payback period. So we have calculated 2 items, payback period and discounted payback period. Now net present value. Look here. So net present value, as same as already here we calculate. So here with the discounted cash flow, here present value is 1,55,629 because this 10% is cost of capital as given in the question. So this is the discounted, this is the factor. So if we cash out adjust with the present value, then we'll get net present value. So it is easy to calculate the net present value. So here 5,621 is the positive. Also we can calculate this one. For example, this one, if we calculate this way, you will get the, with the calculator you can calculate this PV factor, not going to the PV factor sheet. Now profitability index. So there are profitability index. We can calculate 2 ways. One, first we can calculate by the present value, also calculate by the through the net present value. So here if we use the net present value, profitability index, that means PI equal to net present value divided by total investment and plus 1. When we will use the present value only, not net present value, then do not add to the 1. But when we will use the net present value, then we have to add 1. A 1 means 100%. So look here, 5,629 is the net present value. If we divide 150, then it would be this one, 0.0375. If we add this 1, then it 0.13. So profitability index, the formula is that if profitability index more than 1, that project we should accept, because 1 means 100%, and if more than 1, this is the more than 100%. So that is the benefit. So that's that's why sometimes profitability index also used for capital budgeting. So this profit is above the beyond the out of cost of capital. Okay. Now internal rate of return. So basic formula is internal rate of return. As we have seen previously. So here first time we have to take one PV factor, and this PV factor if give the positive NPV, then if we add more, that means we increase the PV factor, then it becomes the negative. So within positive and negative NPV, we will be able to find out the real IRR. So here, if we see in the 10% PV factor, we already calculated in the NPV, and this one here 5629 is the NPV, net present value, this one. So now it is the positive, so we have to take a more or higher NPV, higher PV factor. So higher PV factor is, we are here thinking 15%. Also this is given to our question. Look here 15%. Also you can take 20%, no problem, you can take also 20%. So we are taking here 15%. If we take this 50%, so in the first year 0.8696 is the here discounting factor. Same way in the 5-year 4927. So if we multiply this 70,000 with the 0.8696, we'll get 60,000. And same way in the year 5, we'll get 4,972. Here 1,42,372, but our outflow is 1,50,000. So here net present value is minus 7,629. Now if we calculate the IRR in this way, is also a formula. This formula we can use it. So it is one type of formula is here IRR. Here RA, that means lower discount rate chosen. Here we have chosen 10%. NPV, net present value of A, that means NPV at lower rate, that means our here is 5,000 plus. In the dividing side, that means NPV A minus NPV B, and multiply by IRB. R means higher discount rate minus lower discount rate. So within this formula, if we put the data from here, look here, this is the lower rate, this is the NPV positive one, and here 13,250, how it's come, look here, this is the formula. NPV lower rate, positive 5629. If we minus NPV of higher rate, here NPV higher rate is minus, that means look here, minus 7629. So minus means plus. So plus 5629 plus 7629 is come 13258, this one. And now from this we will get the IRR is, look here the 10%, this one times, and here IRR comes 12.12%. So in this case 12.1%. So we have calculated all items that's requirement. So here is the decision payback. Here result is 2.26 years. That means we can take it discounted payback for NPV 5629. It is the positive, so that's why we can accept it. Profitability index is the more than 1. IRR, it is the more than cost of capital, because cost of capital is 10%, but IRR 12.12%. So it is the more than 10%. So because IRR is more than the cost of capital, then we can accept. So that type of math sometimes you will get, because see, it is also as a this math taken from your question.